Hello, chart watchers, and welcome to this Monday, April 1st, 2019 Market Watchers Live show with your hosts, Tom Boley and Aaron Swenlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Let's get into the action. We've got the Dow Jones Industrial Average up 257 points, challenging the February high. The S&P 500 up 24 points. The NASDAQ up 71 points. And the Russell 2000 up nearly 10 points. The 10-year Treasury yield continuing its move higher off the bottom we saw last Wednesday. We are up more than 7 basis points today, back to 2.49%. Volatility index continues to drift lower, another bullish development. Financials and industrials performing extremely well today, especially the financials, as a result of that 10-year Treasury yield rising. You can see that the bank group and life insurance, two areas that benefit when Treasury yields are on the rise, both performing extremely well today, helping to lead the financials. Also, you can see here that the gambling stocks today having a very strong day as well. They had better than expected Macau gaming revenue and stronger economic data out of China. That boosted the group. You can see one of the primary individual stock beneficiaries is Wynn Resorts, having a very strong day today and up $8 on the session so far. As far as today goes, this is a very special week here at StockCharts. We are celebrating our 20-year anniversary. And to kick things off, let's take a walk down memory lane with Chip Anderson, president of StockCharts.com.
So I founded StockCharts because I have this interest in computer graphics, actually going back to my very early days as a computer programmer, and I did a bunch of graphic work at Microsoft, working on Windows, graphical user interfaces, that kind of thing. But after I left Microsoft, the internet was happening and it was very graphical, and I wanted to find ways to contribute again. And so I had been collecting and looking at a variety of different options. A lot of it was having to do with what domain name could I get, what domain name could I find, and I was looking at the various domain registrars at the time, and I snapped up a couple of interesting ones I thought, but none of them really got me going. And then I remember one night I had been interested in technical analysis from like about 1990, because it was one of the more interesting examples of a Windows program. Metastock was a very interesting Windows program back at the time, very graphical. I didn't understand what the bars meant or anything, but I thought it was an interesting graphics program to play with, and so I started using it. And then I started learning more about technical analysis, starting reading Stock Schematics magazines. So I fast forward to 1999, and I just decided to, hey, is the domain name StockCharts available? And I typed it in, and it was, which was quite amazing. And I remember just quickly going, I need, boom, 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 click buy, and I'm like, okay, I just spent $20 and I've got it. I've got StockCharts.com. And I said, well, okay, let's see what we can do with StockCharts. Initially, we actually were using somebody else's charts on our website. We didn't have enough people and we didn't have enough time to get our own thing. So we were using a third-party charting platform on our website, but it was always our intention, of course, to have our own. And by 2000, we had hired several good programmers as well as some good data people, and they had had enough time to actually put together the initial version of SharpCharts, the first charting engine that we had. And I remember when that was launched, it was really nice to be able to say that the website and the charts were all ours rather than a mishmash of other people's. Was a really good day, really good day. Another piece of the puzzle has always been, how do people find interesting charts to look at? And the scan engine is one of the key things that people can use to look at that stuff. The scan engine was actually created initially, the initial version, by an intern that we had here. We had our first intern was really good. We got lucky. And he created several important pieces of the StockCharts puzzle. The only one that's really left more or less as he originally did it, is the scan engine, or at least the guts of the scan engine. We've added a whole lot more stuff on top of it, and we've done some other things, but the core of the thing is still what that intern wrote many years ago. And it's been a super valuable piece of the entire puzzle. Looking at charts is great, but again, you want to be able to find charts that are interesting, and the scan engine really helps with that. So ChartSchool happened because it's one of our core values, one of our core missions is to provide education to online investors about all this stuff. It's great to have a bunch of really important, sophisticated tools, but you need to be able to explain them and help people understand the right way to use them. And so education has always been one of our core values. Tools, commentary, and education are the three things we focus on, and ChartSchool has been like the major thrust of education for us online for quite some time. The idea is Wikipedia for technical analysis, and just a large, ever-growing collection of educational articles about different indicators, different chart types, styles of investing, styles of analysis, the scanning, all the different things that go into to technical analysis. We wanted to be kind of the home. We thought with the domain name StockCharts, we kind of have an obligation to be the home of technical analysis information on the web, of high quality technical analysis information on the web. And ChartSchool certainly plays a huge role in that. It kind of came together in my mind along with our mission of trying to be educational, to say, hey, while I enjoy going out and meeting people throughout the country, which I want to continue to do, we should also have an event where people come to Seattle and get together and meet each other, because it's not just great for me to talk to people, but it's also great for people to talk to people. So that was where the genesis of ChartCon was born. We did the first one in 2011. About 500 people came, I think. And we spent 2.5 days talking to them about stock charts, showing them all the different features of stock charts, having our commentary experts talk about the market, and also just trying to build community. And it really worked. I mean, I think the people that came to that ChartCon and also the next one that we did in Seattle really kind of connected, not only with us, but with each other, and really positive experience. In 2015, we started doing, we wanted to take the ChartCon concept, but we wanted to have it happen more frequently. Plus, when people were seeing the presenters talk live and they were able to ask questions back and forth, it seemed like more magic happened in that case. And so we started to look for ways to use technology to make that happen more frequently than just the occasional ChartCons. And of course, other things were happening too. Everyone's internet was getting faster. You could use broadband to do video a lot more. And so we took advantage of a service called GoToMeeting.com at the time, and we started to just have these meetings that were really just webinars, really was the right way to phrase them, where from time to time, a couple times a week, different commentators would have a show that people could watch live and learn more about, and also submit questions to. And it was very popular. Initially it was just one show a week, but by the end I think we had 7 shows a week, something like that. I had a show on the weekend. It was starting to take up an awful lot of time, which is both good and bad. Eventually I had to back off because I need to focus on what I do, which is the website itself and the technology and the programming. But I think the genesis of those webinars ultimately evolved into what's now StockCharts TV. ChartCon, we did it in 2011, we did it in 2012, I think we did it maybe in 2014, I can't remember, but the coming to Seattle was a great experience. Like I said, we built a lot of community, but I also got a lot of feedback from people saying, I can't make it. I can't travel to Seattle, or it's too expensive, or I've got other things happening at that time of year, so on and so forth. We looked in holding ChartCon in other locations, something we might actually still do at some point. But we also wanted to broaden the participation. And so how can we do that? Well, based on our success and our working with the GoToMeeting platform, we started to think about, well, hey, can we do it online? Is there some way to make it available to a much larger audience online? And that would also allow us to bring the commentators together in different various locations and still have their interaction amongst themselves, which is, by the way, a behind the scenes wonderfulness of ChartCon is to have the commentators come together and talk amongst themselves, share ideas. But so we wanted that to happen, but we wanted to have it also be able to reach a much broader audience. And so in 2016, I think it was, we went down to Napa, got a hotel down there, and put together a whole bunch of video equipment and internet connectivity and everything else. And we held ChartCon, but as a virtual event on live stream. And I thought it went really well. It hit almost 2,000 people participated in that ChartCon, so much larger audience than we'd had before, and I think they got a lot out of it. We tried and are continuing to look for ways to build community, even though it's this virtual event now rather than a physical face-to-face event. And in the first time we did that with an app, and I thought it worked really well. The amount of communication going back and forth that people were using, I thought was great. So the ChartCon concept also brought us into the world of live streaming on the internet. The ChartCon conference itself was streamed out over the live stream platform, and it was a very interesting event, a different experience than the webinar experience we've been doing up until that point. And because it worked well, it brought up in my mind, well, can't we just do this on a more regular basis? Why does it have to be a specific event that we're live streaming? Why can't we just live stream content much more frequently? And of course, recently things like people cutting the cord, getting rid of their cable, or more importantly, people getting, again, more and more bandwidth into their internet bandwidth that they can use into their house and other places. All that stuff kind of has been happening. There's the concept of narrowcasting, where you get these internet TV channels that are very specific. They're nichey. They're on a particular topic. It's a narrow topic, but it's still a very interesting topic. And so now there are more and more of those kind of channels out on the internet. And I said to myself, why not us? We are a niche. We are a very rich niche. We're a very interesting niche, very graphical. We should be able to do a lot of really interesting stuff in the if we had a TV channel along these lines. And so StockCharts TV was born and launched. We've been building that out ever since, hiring more people, getting more capability in place, so on and so forth, and doing things like this, which is great. Our goal is to continue to grow StockCharts TV and make it a very valuable resource for everybody, not unlike what we did with ChartSchool, but where ChartSchool is a written website, web page kind of thing. StockCharts TV will be a live thing and a video thing. And there's lots and lots of great ideas we have here. As we get more and more people on board, you're going to start to see more and more of those ideas come to you on StockCharts TV.
Welcome back, everyone. I hope you enjoyed that trip through StockCharts history with Chip Anderson. I'd like to bring my co-host in now, Aaron. How are you doing today, Aaron?
I am doing absolutely fantastic. I'm so excited about this anniversary week.
Yeah, this is going to be a big week. I mean, we got a lot of really cool guests coming on to join us this week. Of course, Arthur Hill will be with us here in just a few minutes, and a huge list of folks that have really made StockCharts or helped to make StockCharts great over the years. So I think everybody's going to have a great week of listening in. I know for me, I started with StockCharts back in 2006, just writing on the Chart Watchers newsletter, and then came full time in March of 2015. How about you?
Well, I started out in 2001. Decision Point had a memorandum of understanding, and they created all of our charts. So it was a great relationship. I got to know him early on, and then, of course, we all came online with Decision Point in 2014. So that was a lot of excitement for me joining the staff.
Yeah, a lot has definitely taken place here over the last 20 years. And the good news is I think the best 20 years is to come. The next 20 years, I think, will be even better. But let's go ahead and get in. We got a lot to cover, so I'll let you take it away.
So exciting. We have Greg Morris, we have Gaddis, Martin Pring, John Murphy. All of them are going to be coming in this week, so you don't want to miss any of the days, or at least catch us on YouTube later. But today we have a full packed agenda as always. Arthur Hill is going to be here to give us a really great presentation on the MACD. 10 and 10, our very first symbol is going to be Garmin, GRMN. And then we're going to finish off with our Monday setups, because we can't go without our Monday setups. So All right, let's go ahead and get it started with the tech headlines, and let's do it.
Sounds good. All right. Well, there was a ton of economic reports out this morning. We had February retail sales come in weaker than expected, dropping 0.2% versus the expected rise of 0.3. Retail sales, less autos, came in well below expectations. I will mention, though, that January retail sales and also January retail sales, when we strip out the autos, both were revised quite a bit higher. I think it was 0.5% on both of those. So even though we missed in February, there was a pretty positive revision in January that you need to keep in mind. March PMI manufacturing came in about as expected. January business inventories rose more than expected, and that follows on the heels of wholesale inventories, which we talked about, I think, last week or the week before, having risen. And that can be a good thing if inventories are being built up because the anticipated economic improvement. But if it's going up without that the sales going up, that could be a problem. And it's one of the things that a lot of folks are pointing to right now. We'll have to keep an eye on that. March ISM manufacturing, a little better than expected. And then finally, February construction spending came in well above expectations. So all in all, pretty good reports, I would say. And if we take a look at what's going on in the 10-year Treasury yield, well, we are having a pretty big day. And I will update just to make sure I have the latest. But we have been moving up throughout the day here. We are now at 2.49%. Close to 8 basis points higher. And I'd mentioned back in, end of last month, we had only had 2 days in March where the 10-year Treasury yield put in a higher yield than the prior day, or at least measurably higher. And that has changed here at the end of last week. And then today you can see we are on the move higher. Means money is rotating away from the defensive Treasury group. And that could be a very good thing for the equity market because the equity market's been going up without that money rotating from Treasuries. This week, potentially that's changing. We'll see whether or not we can get back through the 20-day moving average. As far as earnings, there really wasn't anything out. So I'm going to go ahead and jump into a couple of areas of the market that I think are worth noting just before we bring Arthur in. And the first thing was from my blog article this morning under the current outlook. I put a chart in that highlighted the last 10 years, not only of the S&P 500 that you can see here at the top, but also the aggressive areas, the aggressive sectors, and how they've been performing relative to the S&P 500. And I think this is really important to evaluate the strength or the sustainability of a move to the upside. You can see technology just recently broke out. I think consumer discretionary in a really nice pattern just breaking out on a relative basis. Communication services, yes, second half of last year was weak, but I think overall we're still in a nice uptrend. A breakout above the early 2019 high would be very bullish there. Industrials, yes, the last 15 months, industrials and financials have been weak, but I think both are still in longer-term uptrends. So I don't see anything yet to derail the market in terms of relative strength. And so I would continue to approach the market as though it looks pretty good technically. And until I see further technical evidence of deterioration, I would stick with the long side on trading. Now, if we go and look at the financials, the XLF, you can see the move up through January of 2018. Since then, and especially since September, what I'm looking at here is the possibility of a head and shoulder, reverse head and shoulder. So moving down here, left shoulder, the neckline around 27, the lower low prints that reverse head. We come back up to 27, put in that right side of the neckline. The low is almost symmetrical with the left side, so the left shoulder and the right shoulder, very close to symmetrical. I think a breakout here above the 27 level would be bullish for the XLF. And of course, if we pull up the banks, which is a big part of financials, you can see we're trying to get back through the 20-day and the breakdown at about 430. So this would be a pretty important level to see banks continuing to move higher. Also, life insurance. Again, banks and life insurance are pretty dependent on the direction of the 10-year Treasury yield. A rise in that yield helps these two groups, and you can see certainly today both groups benefiting from that. Last thing I wanted to mention was the gambling stocks. We are seeing a big pop here. They're up over 3% today, 3.68%, moving back up above key moving averages. Still got some overhead resistance from February, but nonetheless, pretty good action here. All right, I'm going to go ahead and bring in Arthur Hill. Arthur, I tell you what, not only is he a great friend, but he is a great technician. He has been here since the beginning of Stock Charts. First, welcome to the show, Arthur.
Hey, Tom and Aaron, thank you very much. It's great to be here. And you're right, it is an exciting week with this 20-year anniversary and a lot of people that are going to appear later on.
Yeah, I'm really excited about it. And I think everyone out there is also very excited about it. I thought the presentation that Chip did was fantastic, kind of walking us all through pretty quickly many of the obstacles that were faced and some of the considerations and so forth as Stock Charts grew. And I'm looking forward to a lot of good stuff down the road, and I know you are as well.
Yes, and definitely future chart cons, because I think 10 years ago we did our first chart con together. So yeah. Aaron was there as well. Tom, you were there.
Yeah, 2011 I think was the first one.
So okay, so 8 years ago.
Yep, but then we did 2012, and then it's been the even year since 14.
Yeah, 16. Yeah. Once something gets over 5 years, I just say about 10.
Yeah. Did you have something to add there, Aaron?
No, I'm just saying, yeah, I really enjoyed the chart cons. I can't wait for more of them, honestly. I wish we could do them every year. I know our production staff in the background's going, no.
I think the one thing that I really enjoyed Stock Charts is the community. The fact that we can reach out to the community through our blogs, through this show, through ChartCon. That's a really good thing. And it's been a growing list of commentators, to help with that as well. And I think that's a really big part of where we've been here over the last, really since ChartCon and the addition of a lot of the blogs and so forth. But how did you get started? I'm not going to take out too much time of your presentation, but I think viewers might be interested how you got started with Stock Charts.
Okay, yeah, I was in London at the time, and I just finished an MBA program at City University, and I had my diploma in technical analysis from the Society of Technical Analysts, and I ran across a banner ad for Chip's charts when I was, doing some analysis, and I clicked on it, and I sent an email to this guy named Chip Anderson, wondering if he would be interested in some collaboration, because I was running a website called tdtrader.com, writing analysis and putting up charts. And that was in 1999, just before, right when stocks were going up, before the dot-com bubble. And we did some stuff, and then we decided to meet, and I flew out to Seattle Redmond and met with Chip and was hired as a commentator and to write educational articles. And then it's just kind of grown since then with the addition of a lot of developers. And then Murphy Morris was brought on, and then a lot of other commentaries. It's just been growing ever since. It's a consistent growth trajectory that is quite impressive.
Yeah, and I know you don't want to pat yourself on the back, so I'm going to pat you on the back for ChartSchool. Because I know you've been very instrumental in putting together a lot of that information in ChartSchool, and it is unbelievable. It's like the encyclopedia of technical analysis for folks who haven't been into the ChartSchool. And so on behalf of everybody, I just want to thank you for all the work you put in there.
Absolutely. Thank you. You're welcome. It really was a privilege to be able to do that, because it forced me to really learn these indicators. So when you write about something, when you teach something, then you really understand it. And I was breaking down these indicators and their formulas, and so I knew what was making them tick. And I think that's really important for any indicator that you're going to use, that you truly understand what drives it.
Yeah, I completely agree with you. I say the same thing on the show all the time. I don't believe in any indicator unless I understand it, and I understand what it's telling me, and I understand its limitations, because they all have limitations as well.
True.
This is a pretty good lead in for you, because I know you're going to be talking a little bit about this, so I'm just going to let you take it away.
Okay, thanks. Feel free to chime in, because I'm talking about one of your favorite, if not, I think it's your favorite indicator, right? PPO.
Well, it's right after my indicator making money, but yes, that's the second
okay. One. All right, let me grab the screen here. And so here is the presentation for today. You should be seeing, we're going to show you how to filter MACD and PPO signals to try and improve your performance. Get a little bit of an extra edge on these signals. And I'm going to do some back testing of S&P 500 stocks over the last 20 years to show you how this improves it. It's not the Holy Grail. There's no such thing as the Holy Grail, as I'm sure Tom and Aaron have mentioned time and time again. So we're going to start off with a little overview. I'm going to show you what MACD does, why the PPO is different from MACD, how the signals are generated with crossovers of the signal line and the center line, show you trend filters to add to the stock and to the market index, and then how you can increase the winning percent by using thresholds on your signals and combining thresholds with signal line crosses. That'll be the final tweak that I'll make to this indicator system that might help you improve on your signals. So what we have here first up is Google Alphabet, and MACD is basically the 12-week EMA, which is the green line that you see there, minus the 26-week EMA. So you can see when the 12-day EMA goes above the 26-day EMA, as it did there, the MACD turns positive. And you'll notice that I've got MACD 12-26-0 because I'm not going to show the signal line here. And when you put 0 as the last parameter there, it creates a histogram for MACD. And basically, you can really easily see when the 12-week crosses above the 26-week and when the 12-week, sorry, this should be daily. I don't know why I put weekly. It's a 12-day EMA. Crosses below the 26-day EMA. So that's basically what MACD is. Now, if we scroll down, we'll see an example with Oracle, and this time I'm showing it in the traditional sense where we have the signal line, and I've removed the histogram to make it kind of clean here. We're going to get to the histogram in a little bit, but you can see here when MACD turns down and moves below its signal line, that's considered a signal of some sort. And when it turns up and moves above its signal line, that is also a signal of sorts. It tells you momentum is improving. And there you can see when it gets above 0, that means the 12-day EMA has crossed above the 26-day EMA. So you can see a number of signal line crosses and zero line crosses on this chart. And one thing I want to point out here is you can see that prices here started moving higher at a slower rate. And, you know, they're kind of going sideways, but slightly higher. The 12-day EMA was staying above the 26-day EMA there. But you'll notice that MACD was moving down. And there's a divergence there. But what it's doing is when you're moving sideways, that means momentum is moving towards a neutral stance, so to speak. And so MACD is going to gravitate back towards that 0 line as momentum slows or flattens. And we can see here that it's doing that same thing in February and March. But price is still working higher. It's just working its way higher at a slower pace. That's all it's doing. As long as MACD is positive, that 12-day EMA is above the 26-day EMA. So that's important to keep in mind. So here's the MACD histogram, and I'm showing it separate. And that's a separate indicator that you can use on sharp charts. So what I've got here is, there you can see the 12-day EMA and the 26-day EMA. And there is MACD, and it's turning positive there in middle of January as the 12-day crosses above the 26-day. And then we have the signal line there. And the histogram measures the difference between the MACD and its signal line. So you can see here that MACD is moving further above or away from its signal line. And what that is doing is that is telling you momentum is accelerating in a way. And you can see the histogram, which is the difference between MACD and the signal line. You can see that difference is growing as it moves away from its signal line. And as it moves closer to its signal line there, you can see the histogram moves back towards 0. And of course, when you get a cross below the signal line, the histogram goes below 0. And we're in negative territory for the histogram here for Hilton. And that is because MACD is below its signal line. So that's the basics of how MACD works, how the relationship between the 12-day EMA and the 26-day or week EMA, depending on your time frame there. The relationship between those two is what MACD reflects. And then the signal line is used for early upturns or downturns in momentum, kind of early signals. So what's the difference between MACD and the PPO? So MACD is basically the absolute difference between the 12-day and the 26-day EMAs. So it's just, the price, the 12-day price minus the 26-day price, that's it. So for Amazon, which is a high-price stock, you can see that the MACD is around 37. It's 37.82. What the PPO does is it divides that 37.82 by the 26-week or day EMA in this case, and you can see that it's making it into a percentage. And so this kind of makes it a relative number that you can compare against other stocks, or you can compare back in time using a longer term chart of Amazon. You can't do that with MACD, but you can do that with PPO because it's normalizing the indicator by dividing by the 26-day EMA. So that's why I use PPO, and I think that's why Tom moved over to the PPO for his analysis. Now, the first signal we got here is the signal line, the zero line crossover. And that's basically when the 12-day EMA moves above the 26-day EMA. So here we've got the PPO. And you can see here that the PPO turns positive there in June. And you've got a signal, and it turns negative there in October. So this, of course, is a signal that worked. We know that not all signals are going to work. We had another one working here in October, November, and then a failed signal there in January. Next up, we have Arconic, and we can see here we got some whipsaws when we had the PPO turning positive and then turning negative a few days later. And the same thing happened in December. And then here in January, looks like we had a nice surge and we're ready to move higher. And I think that was an earnings gap, and that does happen. And you can see there were 3 losers in a row. So they're going to be winners and they're going to be losers. The only way we know how an indicator really works is to see or test it on a number of stocks using on a number of signals. So I'm going to look at an Excel sheet, and basically what I've done is I've used Amy Broker software, and I'm using dividend adjusted data, total return data, just like we use at StockCharts, because the total return data is important, because what it's going to do is it tells you the total return, obviously, because if you test something over 20 years, those dividends are important. So you do need to include them if you're looking at the robustness of a strategy. So if we look here, we can see the zero line crossover. And I've added a bull market filter. So I want the 200-day, the S&P 500 to be above its 200-day. And I've added a uptrend filter. So I want the stock to be above its 200-day. So once we're in a bull market, we're having the stock above its 200-day. Then we're looking for zero line crossovers. And I'm only looking for bullish signals here because obviously if you're above the 200-day and we're in a bull market, you want to be interested in only bullish signals. You don't want to take bearish signals because they're against the longer term trend. You're fighting the trend. And I don't think that's a viable strategy for the long term. So we're looking at long positions. So what if every time MACD crossed above its zero line, or PPO, it doesn't matter, crossed above its zero line, you bought, and then you sold when it crossed below? Well, you can see over that 20-year period, you can have 20,000 trades, and a little over 1/3 are going to be winners, 37%. But the average gain is going to be more than the average loss. So that'll make up for the low win percent. But I want to see how we can improve this. And we're not using back testing to say this is going to work exactly the same in the future, but it does help set your expectations if you're going to follow a signal in the future. It's not going to be exact, but it gives you an idea of what kind of winning percent to use. So if you're looking for the 12-day to cross above the 26-day EMA, you're probably going to win about 1/3 of the time, 37% maybe, probably not 40%. You're going to have a low win rate. And over time, your average gain is going to be bigger than your average loss. However, you're going to have losing streaks. You're going to have drawdowns, all right? But you're also going to have winning streaks, and you're going to have moves up in your portfolio value. And because this is done over 20 years and the S&P 500 is up over this 20-year period, of course, there's going to be a bullish bias because the stock market went up over this period. So let's look at how we can improve this signal. All right, we want to get fewer signals, I think, and we want to have them qualified a little bit. And so the first technique that I would suggest looking into is adding a bullish or bearish threshold. So instead of looking for that zero line crossover, perhaps look for the PPO to move above 1%. And you can see here that we got Hormel Foods and we have the PPO moving above 1%. And then you see a couple moves below that zero line, but didn't take those signals and take a signal for a sell when it moves below -1%. And if you go through the books of John Murphy, he talks about adding filter to, say, a moving average crossover. You can add a percentage filter to make it go above a moving average for a certain percent, 1 or 2%, or a number of days. Say, I want it to close above the 200-day moving average for 5 days to see if that's a valid signal and not a whipsaw. So this is an example of a system that would keep you in longer. You're not going to get whipsawed out on moves below the zero line. You're not going to get in at the bottom, of course. You're not going to get out at the top. That's not the way these kind of systems work. You're going to hopefully capture the meat of the move, if you will. So here's another one, and I'm always going to show a positive, bullish, winning example and a negative or losing example because we're going to always have losing trades. It's just part of the process. So this is Mid-America Apartment Communities. And you can see here with the filter that I'm using, we were not above the 200-day when we had the PPO moving above 1% there in April and June. So since we were below the 200-day, these signals were not taken. And then we were above the 200-day in August, and we got a signal with a move above 1%, but the stock went down and the PPO moved below -1%. So that was a loss. So what happens to the back testing when we add this filter? You know, does it make some improvements? So if we scroll down, we can see that I added 2 thresholds here. So we have a cross above 0.5%, a cross below -0.5%, and then a cross above 1%, and a cross below -1%. And you can see the total trades there went from 21,000, almost in half, down to 11,800 or so. So fewer trades. You can see the winning percent went up. It's not dramatic, but this is not going to be a dramatic system, I don't think. But you know, from 37 to 45%. And if you look at the gain-loss ratio, it did go down from 2.79 to 2.42. So your profit-loss ratio, basically. But you're still making more than twice what you're losing on every trade. So I think, you know, that is okay. So we're able to increase the winning percentage by adding that little threshold instead of using the zero line crossover, making it cross over or under by a certain percentage. So let's move back to the charts here, because we're going to look at signal line crossovers next. And what we have here is analog devices. And you can see there are going to be a lot of signal line crossovers, a lot more signal line crossovers than zero line crossovers. And if you took every signal line crossover, you would be taking a heck of a lot of signals. And I think that's why we got to look for a way to filter out these signal line crossovers to learn which ones to ignore and which ones to take. In fact, I think that's a really big part of setting a trading strategy is first figuring out what you want to ignore. Like, you know, I want to ignore stocks that are below the 200-day. I want to ignore stocks for the most part when the S&P 500 is below its 200-day. All right, because that tells me the odds are getting against me on the long side because the bigger trend is down. But when the bigger trend is up, I want to look for bullish setups. So with analog devices, you can see there are going to be some whipsaws. You know, you get in, you get out, there's going to be a loss there. You get in, you get out, there's going to be a loss there. Here we got a gain with the signal line crossover, and there was a really big gain. So there are going to be a lot of whipsaws if you're just using signal line crossovers. And if we look at some test results here, you can see that there were like 100,000 signal line crosses if you had just traded that type of a system. And you can have a 39% win rate, which is, it's okay, but you can see your profit loss ratio is below 2. So this is clearly not a viable system. And we need to add some sort of a filter to it to further qualify our signals and weed out some of the less robust signals. So let's go back to the charts. And what I came up with was, I think there's some validity in the signal line crossover, but I think we need to get the PPO between 1 and -1. And so if the stock is above the 200-day and the PPO moves back towards that center line, which is the 0 line there, then you've had some sort of a correction or a pullback in the PPO or in the price too. So you can see there we get a pullback and the PPO moves towards 0. So that's an area to become interested in a signal line cross when the PPO gets between that 1 and -1 area. But as we saw, if you're using just the signal line cross, you're going to get lots of whipsaws. So you need some sort of a way to keep you in the trade and avoid those whipsaws to try and catch a trend. Now, it's not going to be foolproof, but you can see here we've got the MACD histogram because it's going to be exactly the same as the PPO histogram, but we have a separate indicator for the MACD histogram. So you can see we're above the 200-day right there. And you can see the PPO is in that range between +1 and -1. And then you can see we get a signal line cross because the histogram moved into positive territory there. And you can see we get a number of moves back into negative territory in the PPO. And of course, the signal line crossovers happen because the PPO turns negative. But we don't get whipsawed out, because instead of selling on a 0 line crossover or signal line crossover, we're going to use the first selling technique, which is a PPO cross below -1. So we're looking for a deeper decline to get us out, and also to avoid some of the normal pullbacks that happen like we had here in September, October. And again, it's not a perfect system. Right? They're going to be whipsaws, they're going to be bad trades, there's going to be winning streaks, there's going to be losing streaks, but it's just to provide some food for thought when you're developing a system. You know, you want to trade with the trend, you want to try to find an entry on some sort of a pullback, and you want to be able to ride that without getting whipsawed out on some little pullback. And since the majority of stocks move up during an uptrend, and when they're above a 200-day moving average, that's the direction I would favor playing. So we got another example here with Boeing, and Boeing's been in the news a lot lately. But we can see here that here are a couple of trades that didn't work out. We're above the 200-day moving average there. And you can see the PPOs in that -1 to 1 area. And we get a signal line cross. So that's a valid bullish signal. And Boeing moves up and then it moves down, and we get that move below -1%. So that was a bad signal. Here's another bad signal in August. And you can see with a sell in late October after that sharp decline. And then the S&P 500 was below its 200-day, and Boeing was below its 200-day there. So these signals were ignored. And then here the PPO was above 1, so it was too high. And so that signal line crossover was ignored. So that's why that signal did not take. So let's look at how this might have improved performance here. I'm going to go back to the Excel example. And so just a signal line crossover, we got 101,000 trades. If we had used the minimum maximum values for the PPO, say only take signals when the PPO is between +1 and -1, we got a lot fewer signals, but the win rate wasn't the same, but the gain loss ratio was okay. It improved quite dramatically. But you can see here, if we use the signal line crossover for the buy signal, and then we sell when the PPO moves below -1%, and we ensure that we're in a bull market and the stock is in an uptrend, we get around 10,000 trades over the last 20 years. We get a win percent above 42%, above 40%, excuse me, and a pretty good profit loss ratio. So this seems to be a viable strategy, but keep in mind, you're probably going to need a good uptrend in the S&P 500 to do it. You're going to have some periods when the S&P 500 is choppy and the market is choppy, and you're going to whipsaw it out. And so this is a strategy that would probably have to be implemented over a 6 to 12 month time frame to show some positive results. What I'm saying, you know, if you just do it for 1 month, I think it could have a drawdown. You know, it could also go up, but it could also have a drawdown. And the longer you trade a strategy, the more it'll work out towards the numbers I just showed, as far as, you know, the average gain, the average loss, and the win percent. So let's look at another chart here. Cigna is another example of a losing trade that didn't work, using this strategy here. And now I want to show you a scan, because it's a really easy scan to write here. So we've got here that the S&P 500 is our group. If you want to use mid caps, you can use 400 there. There's a little typo, so I can change that to 400. And I put 2 forward slashes in front of that. And when you put 2 forward slashes in front of your code there, it ignores the code there. So I'm only looking for the S&P 500, but I could remove those forward slashes and look for S&P 400 or S&P 600 small cap stocks. So I want the close to be above the 200-day. I want the PPO to be below 1 and above -1. And then I want the PPO to cross above its signal line. So if we run that scan for stocks today, we're going to get 20 results. And you can click on any of these. We can see some industrials coming in there: Caterpillar, Emerson, and 3M. So this is interesting to see. And you can also sort by clicking that sector. So look at all these industrials that are triggering today. UPS. So that tells me something is going on in the industrial sector. And if I click on this link there, I will see a chart. And that will put this strategy in graphic format, which is what we all like. We all like to look at charts. And you can see here that Caterpillar is making a serious move, and it is breaking out. You know, perhaps this is a bit of a wedge formation, and it's getting above its 200-day. It was above the 200-day the day before, and then you can see we got the PPO in that -1 to +1 range, and we've got the PPO moving above its signal line. Now you say, well, man, I would have liked to have seen this chart yesterday instead of today because it's already made this big move. Well, there's a way you can do that. And this is another reason that we run scans. It's to narrow down our universe and look at the charts for potential setups. So I'm going to put 2 forward slashes in front of that last line. So now I'm looking for stocks that are above the 200-day and have a PPO that are in this range. Now, of course, I'm going to get a lot more results, but it can be something that I can put into a chart list, and then I can look at these charts. So 119 results, more than 20% of the S&P 500. But what I can do is I'm going to put cancel because that went too quick. It keeps going to click. I want to put this in let's try the trackpad. There we go. That's working better. So I want to replace an existing chart list. And I've got a chart list called Scan Dump. And I need to do that again, replace an existing chart list. And then I will move down and put all those results in a chart list. So then you'll have your default chart style, and you can put them in candle glance as well. So I'm going to click View As. I'm going to click Candle Glance. And now I've got all these charts with the PPO on it, and I can see which ones meet my technical criteria. And these are ones that haven't had that PPO signal line crossover yet, but they are perhaps close to it. And so that's something to consider. And with that, I'm going to go back to Tom and Aaron.
Well, that was a great presentation. I was listening very closely. I have a couple questions, but there was one in the room in particular that came in, and it was just regarding the 12 and 26 day moving averages and why we use those versus something that would maybe be equal to like trading week. So how about a 10 and 25 day moving average? Why 12 and 26?
Well, I think the reason, I guess, would go back to Gerald Apel, who created the MACD indicator, and he chose 12 and 26, but I'm not exactly sure why. Do you have any insight into that, Tom?
No.
I can't think of anything. Usually it's just as you were doing, you test and test, and then you just find the one that sort of reacts the way you want it to, because I know the PMO is different parameters.
Yes, and the good thing is you can choose your own parameters. Another version I like to use is the 535. So I can put the PPO on that, and then I can put the MACD histogram on that. And so if you want a shorter term oscillator, you can get it. If you want a longer term, you can get it. So it depends on your time frame, I think.
Mm-hmm.
Yeah, the only thing I would add too is I always say I like to use defaults that most other traders are going to use, because if I'm using technical analysis to try to predict and forecast what others are going to do, it's hard to do that if you're using indicators that are not the same as what everyone else is using. So I always go back to the default. I've rarely, for me anyway, I've rarely changed the parameters. I don't know, if you have any thoughts on that, Arthur.
Well, I also think you need to stick with your parameters. You can't go changing your parameters for every stock or everything that you're analyzing and fit the parameters to it. I think it's important that you're consistent with the parameters you use and you learn how that they're working. And there's nothing wrong with 12, 26, 9, which is the default. It's perfectly fine.
Right. Right. Yeah, you don't want to get into the habit of changing your parameters on an individual stock to make it look like what you want it to want it to be, and then start trading off of that without having done any testing and really understanding why it's acting the way it's acting.
True. Absolutely.
All right. I have a couple questions for you.
Okay.
All right. So all of your discussion here, or at least I think all of it, was based on the daily charts and the daily PPOs and MACDs and so forth.
Yes.
Did you do any testing, like for those who are out there, maybe look at longer term and don't want, you looked at thousands and thousands of back tested trades. Did you do anything with the weekly, maybe to cut the number of signals, number one, and then also obviously to lessen some of that short term volatility?
I have not tested the weekly, but I think that would be a very interesting thing to do. Because you could really capture some good trends using the weekly. You wouldn't get whipsawed out. So I will add that to my list to do, so we can have a follow-up on Market Watchers later.
Yeah, I would think that you're probably going to be looking at bigger gains and bigger losses.
Yes.
Because you're going to hold them longer when they're going down. So you obviously are opening yourself up to bigger losses, but you also wouldn't get whipsawed out of stocks. And I know that there are a lot of long-term investors / traders that don't want to get into this back and forth, in out kind of a thing, that they'd rather, as long as the long term still holding up, they'd rather stick with it. I think that would be an interesting topic maybe for a future day.
Yes, because it does, decrease the number of trades that you're going to make, and you can look at the market on, say, Fridays or on the weekends.
Yes,
exactly. I know how I ended up in the intermediate term, because I just didn't want to watch every single day.
Yeah.
Yeah. And there are a lot of folks.
Now I do, but.
And now look at you.
Now we force you to.
Exactly.
One other question, and I know your 200-day moving average kind of helps this somewhat in that, if you have to be above the 200-day moving average, then you're not going to be in the most lagging stocks. But I was wondering if you added one other filter with the scooter maybe being above 70. So not only is it taking you away from the bottom stocks, but it essentially is only going to give you those stocks that are making those crossovers that have a scooter above 70. Any thoughts on that?
Yeah, I think you could definitely do that, especially let's say we change the scan and we have, instead of 500 stocks, now we have 1,500 stocks. And so we need some sort of ranking system to further filter it out. Now I could, add some code and the scooter is above 70. I'm just going to add sort by scooter. And so when you run that scan, and there's, all right, who can help me here?
Maybe a space before that or?
So.
Yeah, it would be inside, right?
But I think it's with the scooter. So what I'm going to do is I'm going to block out that line and I'm going to click check syntax. And so we can see everything is right. So it's this line that's the problem. And what I'm going to do is I'm going to add that indicator now. So there's the technical indicators. And I can scroll down. And I think scooters are at the bottom or they're at a different. See, this is what happens when you do things on the
upper right hand over there, price volume.
Price volume.
Thank you very much. We can get this together. So add. But okay, there we go. We can add this line here. And the thing will be, we'll already get the scooters and we can do a sort after the scan. So we'll go scooter above 70. So that ensure that there are some strong stocks. And I'll click run. And so now we have 130 out of 1,500. And there's the scooter column that's automatically added. So I can sort that to get the top ones at the top. And of course, the ones at the bottom have the lowest scooters. So that would be another good way to further sort your universe.
Because then you've got, for the most part, uptrending stocks. It gets rid of a lot of the non or underperformers. And if you're looking at a longer term, weekly, it would be really interesting to see how they perform, given those different scans that you ran earlier. If we just say, okay, let's look at it from a weekly perspective, let's take the scooters over 70, I'd be interested to see how that works out.
Yeah, and these are strong stocks. I mean, you just click on Finasair here, and it's well above its 200-day. There you can see MACD is right near, our PPO is right near zero, hasn't turned up yet. So that might be one to watch.
All right, very cool. Well, it has been a pleasure for sure to have you on here this week, Arthur. I mean, I know you've been one of the mainstays here at Stock Charts for a long time. You do just tremendous work. If folks don't follow you, I don't know why. They should be following you. And I think
you're too kind.
based on this presentation, I think everyone can get a sense of how well you know these technical indicators and the way that you can manipulate the data to try and find some great trades. Would highly recommend to everybody checking out Arthur's work on a regular basis.
Thank you very much.
And happy anniversary.
All right. Happy anniversary, guys. Have a good rest of show and a rest of week. I'll be tuning in.
Sounds good. Thank you, Arthur.
All right.
All right. There he goes. First guest of the week. I told you it was going to be a great week. Right, Aaron? We knew it was going to be a great week.
I can't wait for more of it to come. Lots of great videos even. It's going to be so much fun.
Yeah. And there was, I didn't realize we were going to get a little scan tutorial there, but Arthur, gave everyone a lot to think about, not just in terms of, back testing, the trades and all that he was referring to, but also how you can go through and set those scans up. Thought that was fantastic.
Indeed.
All right, well, it is time. We're going to still do the 10 in 10. I'll try to go through it quickly because we want to get into our Monday setups before the day's over as well. So a lot to do still.
Yep, and I do have the RRG. I'll just give you a quick peek while you get yourself ready. And the one things I wanted to note were we do have staples, energy, and financials in the mix today, as well as industrials. They're on the low side. Healthcare, woo! Everybody wants to look at healthcare, so I know we'll get a couple of those in. But let's go ahead and start with the first one, which is Garmin.
Okay, Garmin, the only thing I have negative to say about Garmin is that it is in that recreational products group, which has been an underperformer. But even despite that, this has been a stock that has been easily an outperformer amongst its peers, and also has been an outperformer versus the S&P, despite the fact that its peers have been such a horrible relative performer. So I think you got one of the better stocks in the space. The volume is supporting it. I think there's a lot of accumulation taking place, and I can only imagine how well the stock will do if money actually starts rotating to the group overall. But I like the volume trends. I really like the action here. Of course, I would rather get it on a pullback. I think the rising 20-day is one area I would look. Also, after the big move up with earnings, you can see we did have that initial pullback down close to $80. I think that would would also be a pretty good support level. And then finally, the top of gap support. So those are the levels I'd look for on a pullback, but I like Garmin. I think it's a good stock. Again, would just be better off if we had a little bit more money rotating into its group.
All righty, let's see. Looking at the most popular, honestly, one I know you're going to go over in Monday setups, so I'm skipping that one. A lot of interest in Boeing. Is this a buy now? You know, we got the 2050 crossover. I know the PMO is looking good.
Well, I think getting through the 20-day is certainly the first step. So I like that. Aerospace has been a pretty good area of the market. Obviously, it's been taken down somewhat by the performance of Boeing of late. I think the biggest level on the chart, because I'm a price support kind of a guy, combination, and I think the gap down to, 370, and then the reaction move back to the upside around 400. I'm not going to be convinced on this move until we get through 400. I think we could just be in this sideways consolidation. There were a lot of sellers up here. You look at all that volume, a lot of sellers gapping down from that 420 couple area back below 400. So I think that this is a good start. I think there's more work to be done here.
Okay, let's see. Next one up is for our friends in Canada, ACB.TO. And that, let's see, was in here.
Yeah, that's a cannabis stock.
Yes.
Yeah, I think we may have taken a look at this one last week. I really like that gap support level, and it bounced right off of it. And so here you can see right there the level that I would be watching. I love that move down below intraday and the reversal. So this is one that continues to move up. I think you're in a trading range right now between about 11.5 and 13.5.
Okay. Let's see. Next one up, NBR, Neighbors Industries.
Yeah, the big problem with Neighbors is just going to be the fact that it's been in energy, which has been an underperformer. You can see the oil equipment group right here, really been weak. I'd like to see the group at least make a breakout. We are having a pretty nice day today on Neighbors, but I would be watching this level right here. You can see we had tops right around 300 or just above 300 on multiple occasions. Right now we're at 296. Just look at what's been going on the last 2.5 months. We've gone sideways in this group while the market's been continually moving higher. So what that means is you've got a group that has been a very, very weak performer on a relative basis. And 2.5 months now, it's been going down on a relative basis. So it's just hard to get momentum going in stocks that are in a space that are just being ignored really by Wall Street. So I do like the action today. The volume is picking up, so that is a good thing. I think if we can continue to get strength into the close, the individual stock looks better. But again, I'd like to see a little bit more strength coming into the group in general. I like to trade within areas that are seeing more than their fair share of money rotating in, not less than their fair share. So this would be a stock that would have to be like Garmin. It would have to be something that really stands out. I don't think we're there yet, so I'd pass on it.
All right. Let's see. How about our only consumer staples request, Altria Group, MO, tobacco.
Yeah, tobacco's had a really nice start to 2019. Of course, this was one of the hardest hit groups in the fourth quarter, especially. You can see Altria dropping in November and December. Huge, huge drop there. But the rally's been nice. We've stayed above the 20-day moving average. Here's the tobacco group. You can see making a big push. Haven't gotten up to the prior high, though, just yet, the one back in late October, early November. So overall, I think you've got a group that's just kind of so-so, starting to roll over. I would just say this. If you're in the stock, it has been a pretty good performer. I would just make sure I keep my stop in play below that 20-day moving average. That's where we've been holding so far to date in 2019. You can see multiple tests as you go up here. Didn't quite get there a couple weeks ago, but close. And I would just continue to monitor that 20-day moving average. If we close below it, especially if volume picks up, just remember on a relative basis, you got still have some issues here as the group starts to roll over. So just keep your stop in play.
All right. Here's an ETF for you. The Invesco Wilder Hill Clean Energy ETF, and that is PBW. Do you know what? It averted a double top. So it is interesting to me.
Yeah, I think the reversal here on the 50-day moving average looks pretty nice. So I'm fine with it. I think you got a really nice uptrend, easily taking out the highs in the fourth quarter, which I think is good. And then after all of the buying, the first significant selling that we saw was right here, where we came back down just below 2650. tried to move up, couldn't make it, and then came back down and again tested the support area and the 50-day. I think you can keep a fairly tight stop here. I think a close below 26, and I'd be out of it. But in the meantime, as long as it continues to trend higher, stick with it. We're getting that center line test. Of course, we just spent some time listening to Arthur on that PPO center line test. That's where we are. This is what happens when the momentum just resets over a period of time. You just get a little bit of slowing momentum, get it back to the zero line. A lot of times we take off from there. So I remain bullish the group. I think we go higher from here, but keep that stop around 26.
All right. We always throw a little bit of a small volume stock in there. How about GTS? It is a healthcare provider.
All right, GTS. Yeah, a little lighter volume, but I really like the area where it's at right now. Pretty good volume trends. I wouldn't trade it again because of the volume. I like to have a little bit more volume than this in my stocks. But it's not illiquid. It's not completely illiquid. Today's volume only 29,000 shares, though, so it's definitely light. Here was the big gap up. I'm assuming that's earnings. I don't know that for a fact. Here was a prior high back in November. So this is a range that I would watch. And so far, that has been holding. So I think you can improve your reward to risk by entering at the current price, keeping a stop maybe below 22, and looking for a target up here around 27 and change. So I like the reward to risk on the trade. Not a big fan of the lack of liquidity, though.
Yeah. All right. Let's try an electronic equipment company, NVEC. And this is a really low liquidity one, but there were a lot of people who wanted to see it.
Yeah, this one I definitely wouldn't trade. I mean, 7,000 shares trading today. Just too easy to manipulate, for that. You can see here the stock was trading at 96, went all the way down to 84, and came back to 96 within the same day, and it traded 25,000 shares. I mean, that is just and I'm guessing the bid ask, which is probably wide as well. I don't know that for a fact, but a lot of times they are when you have low volume stocks like this. So I just think there's too much going against the stock from the very start. If I'm just looking at it technically, 104 obviously was the recent high. You got your recent low down around 92 and change. So I think we're in a trading range, but the lack of volume here would definitely keep me out of this one.
Right. Okay. Let's go to a bigger capital company. How about Micron?
Yeah, Micron I really liked on the pullback because it is in a good group. You can see it. Well, let me go back for a second. On a relative basis, this has not been one of the best semiconductors. So here are the semiconductors doing very well, and you can see Micron relative to the group going sideways. So it's going along for the ride. It's going higher, but it's not outperforming its peers. So I'd prefer to be in a stock that is outperforming, but this was a big move on heavy volume. We pulled back at the 50-day moving average, and if we can get back up and break out, watch the relative strength. If it begins to break out on a relative basis, then I could get a lot more bullish on Micron. So I like the group, which tells me that I'm okay with Micron. But right now, I think there are a lot of other better stocks within the semis. I think you've got Xilinx. I think you've got Cree, some others that are really outperforming. And so this isn't going to be a favorite of mine in the space, but it could become one. So let's watch, see if we get the breakout and see if the volume confirms, and then also watch to see if we start to see some relative leadership in the space.
All right, let's see. Next up and final is Pfizer, PFE.
All right, PFE. Well, it's in the pharma space, which has been going higher, but you can see Pfizer on a relative basis is going down because it's going sideways. So this is one kind of like Micron. It's okay, but it's not one of the best stocks within the group. So I personally would avoid it. I think there are other stocks in the space that look a lot better. I think you're in a trading range right now. Maybe look at that range, 39 to 44. But I don't see anything overly exciting about Pfizer at this point.
All right, and that does complete the 10 in 10. Here are the symbols we did just go over. I will have those up in the Market Watchers Live chart list. After the show, just go to the Market Watchers Live blog, and the link will be right there at the top. All right, we'll be right back after this quick message.
Join us April 1st to April 5th to celebrate our 20th anniversary here at StockCharts.com with special guests Arthur Hill, Greg Morris, Gaddis Rose, Martin Pring, and John Murphy.
It is time for our final market update. Let us see what's been going on in the markets while we have been having so much fun. All right, Dow and really all of the major indexes are higher right now. The Dow is currently up just a little over 1%, currently up, let's see, about 264 points. S&P 500 also up on the day. It is up almost 1%. NASDAQ having a great day right now, up 1.09%. Nice gap ups, and then a continuation of those moves. Nice to see follow through. However, S&P 500, Russell 2000, while they are higher on the day, they did have a pullback that we saw earlier this morning, but now it does seem as if they're getting ready to take off and challenge those intraday highs from this morning. Canadian markets straight up, gap up, and continuing to make intraday highs. Treasury yields are higher today, reading 2.494%. VIX pretty much traveling sideways, just like we saw on Friday. And we are currently seeing a reading under 14 of 1369. No change for the dollar right now. Gold GLD is down just a hair, currently at 121.85. USO making a straight up move here, gap up and continuing higher on intraday highs, up 2.25% for USO. And bonds, TLT, really taking a hit today. And you can see big gap down, continuing to fly lower. TLT is down $1.80 right now, currently reading 124.36. And I am going to pass it right back to you, Tom, because I know we have some great Monday setups on their way. What are you looking at right now, though?
Just looking at on the hourly chart, I know last week talked a lot about the fact that we kept going up above and below the moving averages, really kind of directionless. We were kind of waiting to see what the market was going to do. Well, we are now taking out those prior highs. Believe it or not, the S&P 500 is now only about 80 points away, less than 3% from an all-time high. I don't think too many of us thought we'd be saying that three and a half months ago. But S&P looking good, and I would watch this rising 20-hour EMA now. We're going to get a pullback at some point. We'll test it. Let's see if it holds. If it holds and we move higher, I think that's telling us we're trending back toward those all-time highs. So let's go ahead and move into the Monday setups, and I'll let you take it away.
All right. I actually had quite a few come up on my scan today, so I'm just going to blow through a lot of them because there are way more than I normally have. So I thought there were a lot of interesting setups for the intermediate term. Some of these I wouldn't be looking at short term, or I'd look at just as short term. This is one I would look at as a possible intermediate term. We had a nice breakout from a declining trend. I wouldn't pick it as a Monday setup. It's up 2% today, but add it to a watch list and look for a pullback to that breakout point above $29. You can see that was resistance for quite a while. And again, something else I like about that move to the upside, look at the OBV as well. So you've got all that volume coming in on this rally. I think it looks good, but it needs to pull back just a hair. Next one, I'm looking at Darling Ingredients. You might notice that on the poll. This one I liked for a Monday setup simply because it's already done the pullback. It's in the process. We got that breakout. You can see hit the 2180 mark and turn back down. I still think there's room to grow on this. The PMO is flattening just a bit, but we did get the pullback that we really need. And so I would be watching this. It could bounce here now off of that 20-day, 5-day EMA. Again, breaking out of a declining trend. And my upside potential for this one would probably be close to $22.50, maybe $23 based on the top we got back here in February. So again, nice looking OBV as well. Okay, Dine Brands. This was another one I thought was interesting, but needs a pullback. It is up currently over 2%, but you can see a really nice scooping PMO getting ready to move and cross that signal line. I like seeing the OBV breaking out of a declining trend as well on this rally. And look at the positive volume coming in on the rally. So I think this one, again, might need a little bit of a pullback, although, you're sitting in an area that was resistance at about 92.50. If you look at this top back here, it sort of splits the difference between the tops back here as well. But 92.50, really nice to see that breakout above that area. So I liked that one as well. Flagstar Bank Corp. And this one I thought looked pretty good. This was actually, again, it's kind of a big move to the upside today. And I have to say, the one I ended up picking does have that big upside move today, but I like the setup. Right now, you can see we're getting that pullback after the breakout above this area that was a trading channel. So I always think that's positive to see these breakouts above some major tops. You also can see it comes back here to these lows back in July and even April. And we're getting that breakout above that, and now we're pulling back. So I think this one looks pretty good as well. And you can see the PMO doing exactly what we want it to do. Excuse me. Foot Locker. I know we talk about this one a lot. We're getting the breakout. You can see just barely, we're almost there above $61. I'd like to see it close certainly above $61. And PMO looking great. Again, you can see the boost of all this positive volume that came in on that rally. So again, I think Foot Locker is looking good. Ingersoll Rand was another one. This one broke out, as you can see, from that 107.50 area that it had been testing. We're not even seeing any tops right now on the daily. If you go look at the weekly chart, we're making pretty much all-time highs. It looks like I could probably go back to the monthly, and I bet we are. Yes. So at this point, you know, it's anywhere as far as the target. I would be looking just to hold on to it and then watch for maybe a 1 or 2% pullback would be my look. Again, another breakout here. You can see on the Spider Dividend ETF, I did have 2 ETFs come up. This was one. I do like this one. I trade one that is a high dividend ETF. I'm not currently in it, but I think this might be a good time to go there. You can see that double top that did not even execute. So I always find that to be positive when you get a bullish conclusion to a bearish pattern, and a really nice breakout here on the Spider Dividend ETF. Skechers, another footwear one, it's up 2.2%. So again, for a Monday setup, I like to pick some that have already had the pullback. For an intermediate term play, though, I think these are just fine. So you can see a nice big move to the upside here with the volume that came in, which of course has put the OBV in the right place. I would be watching for a breakout above that 34.50 area. I think that still can happen. And let's see, last one that I didn't pick, and then we'll look at the one I did. Nice double bottom here coming off of this short-term decline, and you're getting the execution of it today, and you can see PMO getting ready for its positive crossover. I like Stone Ridge right now, but the one I ended up picking, which is one of the choices on the poll, and it was U.S. Foods. I know it's not a particularly sexy stock here, but I like the setup here because it's still in a nice rising trend. We're getting a short-term breakout. Granted, it is up over 1.25% right now, but you can see it's even pulled back from where I was looking at it. It looks like, oh, it's up 3 cents from where I was looking at it, but nice PMO, nice OBV. I, again, like the breakout. I think on the short-term side, I'd make my target probably about the 36.50 level, and then I would make my stop right about at this rising trend or the 200-day EMA. I would be watching for that breakdown of the rising trend. For the short-term stop, yes, 33.50, because that's kind of where we're at with the rising trend right now, but I suspect I'd be bringing my stop up in the short term. And then IT 32.10 is what I'm looking at as my stop there, and that's mainly because it comes in on this area where we saw previous support and resistance. So I'd be watching that level as far as an intermediate term stop. So intermediate term, I'm looking for a $40.50 target. I think that would be great, of course, and I'd probably be sticking it out until that 32.10 area as far as my stop. But short term, I think I can still eke out a pretty good gain for the week. We'll see.
Okay, USFD it is. We do want to go over quickly what we had last week.
Oh, yes. Sorry.
Oh, that's fine. Let's go through MHO and Xilinx. I know MHO is in that home building area, so I'll take a look at it on a relative chart here. And it made a move early last week, pulled back. I actually like this hammer so far today on the 50-day moving average. It's down a little bit from where you had looked at it last week, Erin. But do you have any thoughts at this point?
Well, it never hit my stop, which was at 24.30.
Okay.
So honestly, I would, if I had gotten in, I would still possibly be holding it. A short-term trade, though, the PMO is on a sell signal now. So if I'm on it in the shorter term, if it breaks down below the 200, I'd probably get out.
Okay. And the other one, the one that I had from last week, Xilinx, I actually traded this one. I got out today. Did have a pretty good week. I think it was 122 and change last week. Got up to just almost 130 today, but you can see if we put the inspector on here, the high close on the stock is 130.05, and it got within 8 cents of that. So my tendency is to go ahead and take the money and let the market, I'll just let everyone else see if we can get through that level. I still think it's a great company. I like the stock. I think it's a leader. If we go back down through here with the relative charts that I look, you can see that semi's doing very well. Get rid of the inspector now. Semis are doing very well. Xilinx has been a tremendous performer. And when I was looking at Micron earlier on the 10 in 10, this is the difference. So Micron, which is kind of just going along for the ride, and then you've got Xilinx, which is leading to the upside. I like the leaders here relative to the S&P, great performance. And the semis have been showing strength in 2019. So that's why that's an area I've been gravitating to. I think this is still a nice looking stock. I just know that the selling kicked in at 130. I don't want to take a chance and ride it back down. So I think the Xilinx continues to look good, but we may see a slight pullback here. All right, this week, what I'm going to go with, my pick for this week is Fluidigm, FLDM. Similar to the relative strength we saw in Xilinx, I think you're seeing the same thing with Fluidigm within the medical equipment stock. So medical equipment broke out above the high it had back in October. On a relative basis, Fluidigm's been one of the best performers within medical equipment stocks in 2019. So I think this pullback is presenting an opportunity. It's been a great performer relative to the S&P, and there is your strength in the group relative to the S&P. So these are the types of stocks I like. I think you're testing gap support and this 20-day moving average. I actually own this one, and I'm looking for a move back up into that 14.25 to 14.50 area where we were recently. Volume trends have been great. I think Fluidigm looks pretty good. Some others that I'll try to go through here pretty quickly. FN. This is Fabrinet. I know we've talked about this one on the show before. I think it's just sideways consolidating, and we're right at a key support level here, or at least we were end of last week, around 51, 51 and a half, something like that. So I think this is a stock that's been just consolidating for a bit. You can keep a fairly tight stop, but my target ultimately would be to go back up and retest this $59, $60 area. MTOR. This is one I traded for a while, and it came back down, and I'm actually looking at it again. Should have probably gotten in if I was going to get in a gap support, or excuse me, price support at about $20. That's where it's been holding. It gapped up with earnings back toward the end of January, pulled back at the 20-day and held on to what was prior resistance becomes support. So that $20 area is pretty important. Trying to get back through that 20-day moving average. I think if we get through it, that would be good. One negative today is there's not a whole lot of volume coming in to support this move. So if I had gotten in at 20, I might be getting out at 21 or 2080 just because I don't like the volume coming in. And there might be a higher likelihood that we fail at the 20-day moving average. HOLX. This is one that I think looks pretty good. I actually bought it today on the pullback. We got a breakout on Friday. I would have liked to have seen a little bit more volume. There's no doubt about it. And medical supplies, though, I took a smaller position because medical supplies on a relative basis has not been a great area. But this stock relative to medical supplies has been awesome. So I think we got a really good stock, sideways consolidation, make the breakout on Friday. I got into a small position that closed below the 20-day, and I'm going to get out. So that's just give you some sense. I'm not really interested in holding this one for very long. And let's take a look just at maybe 2 or 3 more. We got Alphabet. I think this pullback to test the breakout is a really nice looking setup. Nice push back to the upside today. Internet was doing a little bit better today. You can see it starting to turn higher here. Google relative to internet was doing really well until the first 5 weeks of this year, but it has been building again on a relative basis. So I like that relative strength building. And then finally, you can see after a move up over about a 2-3 month period, internet on a relative basis just consolidating. Watch for a breakout above about 0.615. If we make that breakout, I think stocks like Google become much more interesting. Amcor, this is in the semiconductor space, AMKR. And this one's been sideways consolidating. So on a relative basis, it looks like it's a really bad performer, but it hasn't broken down, and it had such a huge move on volume. I'm giving it some time to consolidate here. I think we could be getting another push to the upside. A breakout above 9 here would be very strong. And I'm going to do one more. Let's take a look at Etsy. This is one we've talked about a lot here on the show. Continues to be a great performer, but it has been sideways consolidating on light volume. I believe this 62.5 to 65 area is a great area of support on the stock. And this has been one of the better performers, as you can see, relative to its peers, and also doing well relative to the S&P. So let's go ahead and go with that for this week's Monday setups. And you can see Aaron is going with USFD 35.36. I will go with FLDM Fluidigm at 13.23. And we'll see how we do next Monday.
Indeed.
All right. Well, it has been a great first day of this week. We do have a poll, so we're going to bring that up for you. And we thought we'd let you all participate in the Monday setups. So a couple of Aaron stocks are up there, a couple of my stocks are up there, and then just a couple of other random stocks are up there. And Aaron, the random stocks are
there. I wouldn't say my picks are up there. I'm holding down the last two. You know, they're consumer staples. They're not sexy, like I said. But for a short-term 1 week trade, I think they're lined up pretty well. But I have to say, looked at the Shake Shack chart. I have to agree with that third of our audience that one's looking good. It really is.
All right. Well, I know I'm going with Fluidigm because I own it, so I have no choice. I've got my money at stake. I think, yeah, Shake Shack looks good. I think it's a little overbought. I'd rather get it a little bit on a pullback. You know, maybe around 55.5, 56, but definitely looks very strong, and it is in that restaurant space. The restaurants have been great. I like in that space maybe Starbucks better. I like CMG better, but Shake Shack, because of the recent breakout, certainly is picking up steam on a relative basis. So I could go along with that one as well. That's a nice looking chart.
Mm-hmm.
All right. I wonder how that got picked. Zach, do you want to chime in? We got about 30 seconds. Did you put that in there?
There might have been some sort of burger joint establishment talk here in the office, so that's how it got picked.
I was going to say it must be the lunch destination or something today, Shake Shack.
Yep. Well, we always talk about sometimes the charts looking tasty. So.
Oh, there you go. Little pun. Throw a little pun in there for the end of the day.
I don't do that.
Well, this was a great show. Hope everybody out there enjoyed it. I mean, having Chip come on, talk, about the history for, 10, 12 minutes. I thought that was a great recap of where the company has been. I can tell you where we're going. We're going a lot further ahead. So please stick around, stick with us. There's our upcoming schedule. Check it out. Some real tech titans going to be joining us the rest of this week. You don't want to miss it. I want to thank all of you for being with us today. Special thank you to Arthur Hill for joining us. Please remember to complete the survey as you exit, especially this week. We'd love to hear what you think of this week's shows. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Monday afternoon, everyone. We'll see you back here for day 2 of our anniversary week. Happy trading.